The secret to building wealth is easy, but here's one problem. The financial world is making it really complicated. It lies in mastering 5 essential rules that can transform your financial future today. In this video, we will uncover these crucial strategies and show you how to build substantial wealth over time. So let's start with the most important one, and that is number 1. Emphasize long-term investing. When you want to be a successful investor that will become financially free after 30 years, you need to pay attention to the following, and that is prioritize a long-term investment strategy over short-term trading. Investing is like running a marathon, not a sprint. The stock market's true value becomes apparent over extended periods, while frequent trading or market timing often leads to lower returns. So, to explain this, I often use the example of the hare and the turtle to illustrate this concept. The hare represents short-term investors who are quick and overconfident, seeking fast gains. The hare sprints ahead at the start, similar to investing, making quick trades or trying to time the market for immediate profit. The turtle symbolizes long-term investors who adopt a steady and patient approach, much like a marathon runner who maintains a consistent pace throughout the race. The turtle remains calm during market fluctuation and trusts their long-term strategy. And despite the hare's initial speed, its inconsistency and hasty decisions ultimately lead to a loss. The turtle, on the other hand, wins the race through persistence and steady progress, demonstrating that long-term investing, like running a marathon, requires patience and a long-term mindset. But it isn't only a long-term mindset, because if you do not pay attention to the next important step, you will miss out on a lot of money, and that is number 2. The importance of low cost in investing. Think of your investment account as a swimming pool. When you fill the pool with water, your investments, you expect it to grow over time. Suppose you have a swimming pool with a 10% return, but there's a leak in the swimming pool, and that represents your investment fees. Initially, the leak might seem small, but over time it significantly impacts your pool's water level. So at first the leak might not seem substantial, but here's the thing. As time goes on, the consistent leak slowly drains away a significant portion of your gains. With this compounding effect, the impact of this leak becomes more substantial over time. For example, if you invest $100,000 over 30 years with a 10% return, you will end up with about $1.7 million. But if you paid 2% annual fees, you would end up with around $1 million. The difference is $700,000. And this means that a 2% fee results in about 42% less money over a 30-year period comparing to having no fees. So this highlights how high fees can significantly reduce your returns over time. So do you see how important this is? But some investors are still a little stubborn, like I was in my 20s. That's why I call this the number 3, the importance of diversification. Buying the haystack, not just the needle. If you focus only on finding that one needle, that single investment, you are betting everything on a single chance. And this approach can be risky, as you might spend a lot of time and effort with little guarantee of success. Instead, imagine you could buy the entire haystack. By investing in a wide array of different investments, you are not just focusing on one potential winner, you are spreading your bets across many options, increasing your chances of finding success. If one needle, one investment doesn't work out, you still have many other options to rely on. So if you found these investment rules valuable, don't miss out on the wealth of knowledge we have next for you. Subscribe to our channel now for exclusive tips, insightful strategies to boost your financial success. Then we go into the next important step, and you cannot forget this one to be successful with building wealth. And that is number 4, the importance of time in the market versus timing the market. So imagine you are planting a garden. If you consistently work on it, watering it, adding nutrients, and taking care of the plants, you will eventually see the bountiful harvest, right? So you can say the longer you care for your garden, the more it will thrive and grow, producing a rich yield over time, right? So why would you wait for the perfect planting day? Now imagine you are trying to time the perfect day to plant your seeds. You might wait for a specific weather condition or lunar phase, believing it will guarantee a better crop. In the meanwhile, you keep missing planting opportunities because you are waiting for ideal conditions. If you spend too much time waiting for the perfect moment, you miss out on the steady growth and eventual harvest you could have had by planting consistently. If you miss out on the best investment days, this could make a huge difference in your portfolio. Then, the last important rule where you can make the difference in your portfolio: the importance of regular contributions. Consistently adding to your investments, even in small amounts, can greatly enhance your portfolio's growth and wealth over time. And this strategy leverages the benefits of dollar cost averaging and compound interest. And then, number five, think of it like building a strong foundation. Imagine you are building a house, and if you consistently add bricks to your foundation, the house will gradually become more stable and robust. Even if you add just a few bricks each month, over time you will build a solid structure, right? In investing, regularly contribution to your investment account is like adding bricks to your financial foundation. Each contribution may seem small, but over time these additions accumulate and significantly increase your investment's value. And this approach also helps smooth out market volatility because you are buying investments at various price points, reducing the impact of market fluctuations. So, for example, when you invest $500 every month for 30 years with an average annual return of 10%, you have seen in our early example, your investment grows significantly due to the power of compound interest. But the key is to start today. It's not just me saying this, it's one of the greatest financial experts like Jack Bogle, who made significant contribution to the industry, shared the same philosophy. So check out his insightful video, Jack Bogle's 10 of the most important rules of investing. You definitely don't want to miss it. And if you want to see more videos like this, please subscribe to our channel and stay up to date.